Here is something that will completely reframe how you think about money. The wealthiest people on the planet are not debt-free. They are not sitting on mountains of cash they saved up over decades of careful spending. In many cases, they are carrying more debt than most people will ever see in their lifetimes. And they are doing it deliberately, strategically, because they understand something about debt that almost nobody teaches in school, in personal finance books, or in the mainstream conversation about money. Debt, used correctly, is not a burden, it is a tool. And in the hands of someone who understands how to use it, that tool generates more wealth than income alone ever could. My name is Tomas, and this channel is about finance, automation, and building wealth through the strategies that the wealthy actually use, not the watered-down version most people hear. If you are new here, welcome. Hit that like button right now and subscribe so you never miss a video. Today, we are going through 6 specific ways rich people use debt to make money. And by the end of this video, you will never look at debt the same way again. Let's get into it. Before we get into the 6 strategies, we need to establish the foundational distinction that makes everything else in this video make sense. Because without it, the strategies sound like reckless financial behavior, rather than sophisticated wealth building. The most important idea in this entire video: good debt versus bad debt. Bad debt is debt used to fund consumption. Credit card balances carrying 20% interest because you bought things you could not afford. Car loans on depreciating vehicles financed over 7 years. Personal loans taken out to cover lifestyle expenses. This debt takes money out of your pocket every month through interest payments and produces nothing in return. It makes you poorer over time, quietly, automatically, and with mathematical certainty. Good debt is debt used to acquire assets that generate income or appreciate in value. A mortgage on a rental property where the tenant's rent covers the payment and then some. A business loan that funds a venture generating returns higher than the interest cost. This debt also takes money out of your pocket every month, but it puts more back in through the returns generated by the asset it funded. Used correctly, it makes you wealthier over time with the same mathematical certainty. Rich people are not reckless with debt. They are disciplined about the distinction between these 2 categories, and they use good debt with precision while avoiding bad debt almost entirely. That is the framework. Now let us get into the 6 specific ways it plays out. The first way is using leverage to acquire real estate. This is the most widely practiced and most accessible form of wealth-building debt available, and it is the strategy responsible for more millionaires than almost any other approach in financial history. When a wealthy investor purchases a rental property with a 20 or 25% down payment, they are using the bank's money to control an asset worth 4 to 5 times their invested capital. The tenant pays rent. The rent covers the mortgage, taxes, insurance, and maintenance, and the investor builds equity through appreciation and loan paydown on an asset worth the full purchase price, while having deployed only a fraction of that amount in actual cash. The leverage multiplier here is what makes this so powerful. If a $300,000 property appreciates by 5% in a year, it has gained $15,000 in value. The investor who put down $75,000 has just seen a 20% return on their invested capital from a 5% appreciation in the asset. No investment without leverage produces that ratio. And as the portfolio scales, 2 properties, 5 properties, 10 properties, the combined effect of leverage, appreciation, cash flow, and loan paydown across multiple assets creates a compounding wealth engine that salary income alone cannot replicate. The second way is using business debt to generate returns that exceed the borrowing cost. When a business owner borrows money at 6 or 7% interest to fund an expansion, hire key employees, purchase equipment, or launch a new product line that generates returns of 20, 30, or 40%, the debt is not a liability. It is an arbitrage. The investor is borrowing money at a known fixed cost and deploying it into opportunities generating returns significantly above that cost. This is precisely the logic that private equity firms, growth stage businesses, and sophisticated entrepreneurs use when making financing decisions. The question is never simply whether debt costs money. The question is whether the return on the deployed capital exceeds the cost of the debt by a meaningful margin. When the answer is yes, and when that assessment is based on realistic projections rather than wishful thinking, debt is the most efficient fuel available for accelerating business growth. The third way is the buy, borrow, die strategy. This is one of the most powerful and least discussed wealth preservation strategies used by the ultra-wealthy. And once you understand how it works, it becomes clear why people with significant assets structured correctly can generate effectively tax-free income for decades. Here is the mechanism. A wealthy investor holds a portfolio of appreciated assets, stocks, real estate, a business stake, that have grown significantly in value. Selling those assets to access the wealth would trigger capital gains taxes, potentially significant ones depending on the gain and the jurisdiction. Instead of selling, the investor borrows against the portfolio, using it as collateral for a low-interest loan. The loan is not taxable income. It is borrowed money, and borrowed money does not appear on a tax return as income. The investor then lives on or invests with the loan proceeds, repays the loan from ongoing income or new borrowing, and continues allowing the underlying assets to appreciate tax-deferred. The die component of the strategy refers to the step-up in cost basis that occurs at death in the United States tax code, a provision that effectively resets the capital gains tax liability on inherited assets to zero at the time of transfer. This means the heirs receive the appreciated assets without the capital gains tax that would have been owed if the original investor had sold at any point. Combined with a lifetime of borrow rather than sell behavior, the result is generational wealth built and transferred with the tax burden reduced to a fraction of what a conventional sell and reinvest approach would have produced. The fourth way is using debt to invest during market downturns. Wealthy investors do not just tolerate market downturns. They prepare for them in advance and deploy capital into them deliberately. And one of the tools used for that deployment is strategic debt, specifically margin loans or lines of credit secured against existing assets that allow an investor to purchase additional assets at depressed prices without having to liquidate holdings to raise cash. The fifth way is using debt for tax arbitrage. Interest paid on debt used for investment purposes is tax deductible in many jurisdictions, meaning the after-tax cost of that debt is lower than the stated interest rate. A wealthy investor borrowing at 7% in a 37% federal tax bracket, using the proceeds for investment, has an effective after-tax borrowing cost of approximately 4.5% after accounting for the interest deduction. If the investment generates returns above 4.5%, which broadly diversified index fund investing has done historically, the debt is working in the investor's favor on a net after-tax basis. Real estate investors use this mechanism with particular effectiveness. Mortgage interest on investment properties is deductible. Depreciation provides additional paper losses that offset taxable income from the property. And the combined effect of interest deductions, depreciation, and operating expense deductions can allow a property generating positive cash flow to appear to generate a tax loss on paper, meaning the investor receives real income while reporting little or no taxable income from the investment. The sixth way is using debt to fund equity-building business acquisitions. Buying an existing profitable business using primarily borrowed money, a strategy called a leveraged buyout at the institutional level and seller financing or SBA loan financing at the individual level, is one of the most powerful wealth creation mechanisms available to entrepreneurs with limited starting capital. Here is how it works in practice for an individual buyer. A profitable small business, a service company, a franchise, a manufacturing operation, a professional practice, is purchased using a combination of a small down payment from the buyer and a loan funded either by the Small Business Administration, a private lender, or the seller themselves through a seller financing arrangement. The business continues operating, generating revenue and profit. That profit services the acquisition debt, and after the debt is paid down, typically over 5 to 10 years, the buyer owns a fully profitable asset free and clear, having used the business's own earnings to pay for the purchase. So there are the 6 ways rich people make money with debt. Real estate leverage that multiplies returns on invested capital through tenant-funded mortgages and compounding appreciation. Business debt deployed into opportunities, generating returns that far exceed the borrowing cost. The buy, borrow, die strategy that allows appreciated assets to fund a lifestyle or generate investment capital without triggering a tax bill. Strategic debt deployment during market downturns to purchase depressed assets at extraordinary prices. Tax arbitrage through investment interest deductions and real estate depreciation that reduce the after-tax cost of borrowing below the return on invested capital. And leveraged business acquisitions that use the target company's own cash flow to fund the purchase price. None of these strategies are reckless. Every one of them is disciplined. The difference between debt that builds wealth and debt that destroys it is not the amount. It is what the money does after you borrow it. Use debt like a tool, never like a crutch. If this video shifted how you think about debt and wealth, please hit that like button. It genuinely helps this channel grow. And if you are not subscribed yet, click that button right now so you never miss what is coming next. See you in the next one.